Well, global bond yields are jumping today as hawkish-sounding Fed minutes add to concerns that rates will stay higher for longer. The US benchmark 10-year yield sits at 2008 highs, UK gilts jump to a 15-year high, and German bond yields also spike. Now, the move suggests investors are putting another Fed hike firmly on the table. Investors are now seeing a 40% chance of a rate hike by November after the release showed participants are wary of the possibility that inflation will not ease and further hikes will be necessary. Now, a quote from the minute says, quote, most participants continue to see significant upside risks to inflation, which could require further tightening of monetary policy. Joining us now is Matthew Miskin, John Hancock Investment Management Co-Chief Investment Strategist. Thank you for joining us this morning. So we're seeing a lot of cold water now being thrown on a lot of this enthusiasm that we had seen in the markets. Do you think it's really sinking in? I mean, the Fed has been really saying higher for longer for months now.
Right, and it's almost been a full year. So this time last year, we had the Jackson Hole meeting, and Powell came out and said there's probably going to be below trend growth and pain to households and businesses. And a year later, we've got real GDP. According to GDP Now, the Atlanta Fed version is showing 5.8% real GDP growth coming out of Q3, coming into Q3 here. So you're almost seeing a reacceleration of growth. We think that this reacceleration is not what the Fed wants to see right now. They would like to see actually some of the loosening of the labor market. They'd like to see inflation come down, but stronger growth in the U.S., somehow remarkably resilient from these higher rate hikes, is going to pose a challenge for the Fed next week at Jackson Hole.
I mean, and we know that it really does show that the economy can take these rate hikes. But what are we looking at then? If we still see inflation obviously moderating somewhat in some aspects, still some stickier parts, but still seeing then this reacceleration of growth.
Yeah, it's such an odd complex of, in relative to history, this just hasn't happened often at all. But in our view, interest rate hikes take time to filter into the economy. An analogy kind of think about is when we did all the stimulus out of COVID, it was like an injection into the economy. So we flooded the economy with stimulus. And now the Fed has to slow down the economy, normalize it. And it's almost like sleeping pills, where you take these pills, you don't know how long it's going to take for them to really be felt in the body and the economy. And so it's taking time. It is likely still to be felt by the end of this year and into 2024, but it's just been amazing to see how resilient the economy is. We've seen some fiscal side, some spending. We've seen a lot of anecdotal evidence of either blockbuster movies to concerts that are doing well in terms of the U.S. economy. But eventually, we do think this fighting the Fed for risk assets and for the market is going to start to wear down that market. And we think that's going to actually cause a bit more choppiness and a bit of a rotation into more defensive parts of the market as we move into 2024.
And you mentioned some of the blockbuster, movies that people have been spending on, the Taylor Swift impact, but you also noted the Inflation Reduction Act and more labor participation from women coming off of the heels of COVID as well. How much is that playing into what we're seeing?
I mean, you're looking into the economy and you're saying, how is it doing so well? And those are the two things that we see as the biggest drivers right now. So the Inflation Reduction Act had a pretty big side effect in that it created more CapEx in the U.S. and specifically in the Midwest and Southeast. And so if you're going to build semiconductors in the United States, you got to build massive manufacturing capabilities to do that, or electronic vehicle parts, or just doing more wind type or alternative energy sources. All this requires huge investments. So right now, the United States is putting all this investment in, and it's not counter-cyclical. Usually the government does fiscal policy like this when we're in a recession. They did it when the inflation rate was too high. And so they thought they were actually reducing inflation. They're probably actually accelerating it, which is just a bad side effect in timing-wise. But then to your point, the women participation in the labor force is now about 50%. That is near all-time highs in this country. From the Barbie movie to Taylor Swift concerts, the women in the country are really stepping up to the plate in terms of the labor market, and that's filling that massive labor gap that we had. And that's likely one of the biggest secret weapons the country has. And we're, United States-wise, is holding up the best globally, economically speaking. One of the reasons we like the U.S. out of all the investment opportunities out there today.
And speaking of sort of the global look at things, we know that we're going to be having that Jackson Hole meeting, the global central banks really getting together here. And at the moment, really seem to be pulling for this higher for longer rate expectations as well. How important is this Jackson Hole meeting that's coming up before the Fed has its next meeting?
We actually think this one's going to be more important than usual. So some of these Jackson Hole meetings are kind of a non-event. They come out of it. They're like, well, we did some research. Great. But this one, I think Powell wants to signal that, they're still going to be hawkish and that, September could be in play as a rate hike. I also think it is interesting in terms of talking about all these central bankers coming together. What's interesting is that while the ECB, the Fed, and the Bank of England are all saying, let's raise rates, let's get this inflation problem done, China's stimulating. And this is the worst time for all these other central banks that are wanting to slow the economy, normalize it, get inflation down. China last night even was starting to intervene in the market. And every time you see China economic weakness or market weakness, they start to pump money into the market. That then spurs risk taking and also causes commodities to jump. So oil prices are higher today. Copper starting to slow down its descent. So you've got this counterbalance where really a lot of central banks are going to meet up and say, we got to get this inflation problem. And then you got China, the second largest economy in the world, saying we're stepping on the gas to get our economy back growing. And it's this tug of war. And we think eventually the developed central banks win out. Right now, it's a tough backdrop to get that right.
So for retail investors who are trying to connect the dots between all this different data that's coming out of China and what this means for sort of investment prospects and how it impacts the US economy, what's the key thing to take away there?
Well, globally, we see the U.S. looking the best, economically speaking, earnings-wise. And the U.S. equity market is the highest quality market in the world. And what I mean by high quality, good balance sheets, high ROE, good profit margins, and good profitability. And we would really emphasize higher profitability, good quality stocks in equity portfolios today. That's leaning us into the U.S. versus the rest of the world. And then in terms of other opportunities, defensive stocks like healthcare or utilities, have gotten crushed this year. They've massively underperformed. We see them as relative value opportunities, and there's high quality income available today in the bond market. We would look at defensive sectors like healthcare and some bonds. I know bonds have been selling off. It's been tough, but the higher the yield, the more likely you have better total return going forward and nice income stream generation. Those are great opportunities in what is a challenging backdrop. So we would take a look at those.
Lots of great insights there. Appreciate you joining me this morning, Matthew Miskin, John Hancock Investment Management Co-Chief Investment Strategist. Appreciate your time today.